Professor Jamie Hopkins comes on this episode to discuss how sophisticated financial advisors are prudently incorporating home equity into retirement income plans.
This is the Resilient Advisor Podcast, the show for high-performing financial advisors. We bring you the best practices of the industry's top performers so that you can build resilience in your business and your personal life.
Thanks for downloading this episode of The Resilient Advisor. My name is Jay Coulter, and on this episode, I get to interview an expert on a topic that most financial advisors do not understand, and that is the power of leveraging home equity into a retirement income plan. Professor Hopkins is the co-director of the New York Life Center for Retirement Income. He's a professor in the Retirement Income Program at the American College of Financial Services. He's a regular contributor for Forbes and Investment News on retirement income planning. And he's also a retire mentor for MarketWatch and has been published in dozens of journals regarding tax law and retirement income planning. Jimmy, thanks so much for coming on the show.
Jay, thank you so much for having us on here and getting to talk about this topic, which is near and dear to my heart.
Yeah, usually when I'm preparing for an interview, I can understand the topic well enough just because of my years of experience in this business to carry on a very deep and articulate conversation. Jamie, I got to admit, I'm struggling with this topic, so I'm glad you're here to educate me and our listeners on this topic. So I found some research that you put out, or some articles on some of the research that you've been citing in the media, and I just want to share it with listeners before we get started. So you said in a recent post that with 77% of retirees' net worth locked in home equity, it's astonishing why so many financial planners ignore home equity when creating retirement plans. And then you went on to cite research by the Insured Retirement Institute that says 24% of baby boomers have zero retirement savings, which is the lowest number they've ever recorded. And then other data points to only 55% of baby boomers having some retirement savings. And of those, 42% have less than $100,000. Jimmy, this is an epidemic.
Yeah, and this is, we're facing that retirement crisis right now. And, people really head into retirement, some of those numbers will tell you, with kind of three things. And so, we've got Medicare at 65, which isn't a perfect system, but honestly, it's been pretty good. We've got Social Security, which is the primary retirement income source of so many Americans, especially, lower income, middle America. That's really what they rely on. And the other thing that people have in retirement is their house. And we still have most retirees are homeowners to some degree, home equity. And when you kind of look at the U.S. Census data, which is the data that I usually go off of for home ownership and kind of the value of the home, we see that that's about, as you said, 70-some, two-thirds of their assets for the average married retiree. And when I say average, 65-year-old couple, median wealth, two-thirds of their wealth is in their home. And so this is really America's largest asset. And most financial advisors and most retirees leave that kind of alone. They leave it untapped, which is not always a bad thing. But I think that's, if we're going to make it through the baby boomers retiring, we're going to have to pay attention at least to America's largest asset, which is home equity.
I found an episode of Consuelo Mack's PBS show WealthTrack where you were on there talking about some of the strategies that could be implemented, and I'll put a link to that episode in the show notes. But as I was listening to that, I thought it'd be helpful for even some of the more seasoned advisors to really get a 101 on what that looks like. So starting from the very beginning on how they could implement in a plan and what it looks like.
Yeah, so I can talk a little bit about kind of what does it mean to incorporate housing wealth into a retirement plan. And so it actually starts with some fairly basic questions, right? Do you own a home? Do you want to age in place? And how long do you kind of plan on living in this home? And so those are some really basic things that maybe you're doing. We also want to know about any debt that's associated with the home. Is there an outstanding mortgage? And advisors sometimes do that and then might say, hey, let's refinance. Well, the refinancing world's about to come to a screaming halt. We had through the 2000s and actually for the last 10 years also, we saw a lot of people cash out of their homes. And what that means is more and more people are heading into retirement with some mortgage. And interest rates have been so low that refinance at some point is going to kind of stop. Everyone has the lowest rate possible. And so part of that's happening. So we do have to manage debt and manage mortgages. But let's say we do have home equity, which is true for most people, even with a mortgage. The house is probably not underwater. Now, what are you doing when you're paying off a mortgage and putting assets into a house? You're kind of doing two things, and actually you can kind of compare it to a whole life policy, which is really one of the things you're doing is you're buying services, and what you're buying is housing services. You need a place to live, so we're buying that. The other thing we're doing is we're actually saving, and we're actually saving in what's essentially a tax-deferred savings vehicle that mostly allows for growth to be recovered tax-free, right? $250,000 if you're single of home equity gain, and $500,000 if you're married. And so for most people, we're not going to pay gain on the sale of a house. So we've got this asset that's kind of tax deferred growth, and but then that's the next question: is a house a good investment? And most of the research will tell us that a house is actually a terrible investment from the investment portion of it. Now, buying housing services is good because we need a place to live, but the growth in housing historically basically keeps pace with inflation. Now, some areas, you'll be in California, housing prices skyrocket. If you live in San Diego, nobody can afford a house there now. And if you're in Detroit, they bottom out, right? And they became zero. Mm-hmm. And so you can buy a house in Detroit today online for $5,000. So there is a good degree of risk in any one specific house. And what we see is people actually tend to be overweighted in that, where 2/3 of their wealth is in their home and not other areas. And so we've got a lot of wealth in their home. So now what do we do with that once we get to retirement? And there's a couple different things we can kind of account for. One is, are we going to use home equity? And do we feel comfortable using that strategically throughout retirement to support our lifestyle? Or two, do we want to leave that alone and we don't want to mess with our home, and we're going to leave it as a legacy asset to our kids? And for some people, that's what they want to do. So we're not going to touch the home. It's a legacy asset, and we can put it in that bucket. Or are we going to use it as a long-term care funding mechanism? And that's really kind of the third one. And for a lot of people, that's the strategy. At some point, we plan on moving into a nursing home or assisted living or CCRC, continued care retirement community, and we're going to sell the home in order to fund that. And so I think those are really the three main kind of housing bucket strategies we can use. So kind of selling it, for long-term care, that's fairly straightforward. The leaving it to your kids, fairly straightforward. But then the other part, how would we use it kind of systematically and strategically to support our income and lifestyle? That one becomes more complex. And so we do have products for that. The reverse mortgage is out there, which we'll probably get into a little bit more detail. But we can use that to offset some common risks that financial advisors are at least aware of, sequence of returns risk. And I just sometimes give a very quick example of this. Would you rather borrow from your house at 4% or sell your stocks in retirement to generate your income when they're down 40% in a 2008 type time frame? Well, the math is really easy there, right? I'd much rather borrow at 4% from my house than sell my stocks when they're down 40%. And there's a growing body of research in that area that says, that extends the longevity of a retirement portfolio, because we can use home equity to offset some sequence of returns risk like any other buffer asset strategy, using cash value life insurance, just cash, which is sometimes tested and not a great strategy, but some type of buffer zone strategy can be very helpful there.
Interesting.
So I'll probably give you a second to hop back in here.
I can tell you're passionate about this topic, and I can clearly see the benefits the way you're articulating it. But let's get into the granular details of those reverse mortgages. What does that look like? And specifically, if you could speak to the advisor that's never looked at that type of product before. What's the process? What are the benefits, and what are the risks?
Yeah, so the first thing, when I talk about reverse mortgages, you have to acknowledge the elephant in the room is that you're probably coming into it if you've never looked at it with a slightly negative perception. That's what my research shows, and I've done a tremendous amount on kind of attitudinal stuff around reverse mortgages. And so that's going to be the starting point. So what I usually tell advisors is, think about this, right, as just another financial product that just got offered in your line of business. Let's take a look at it first, and let's look at the details and see, does it make sense? And it's probably not going to make sense for all of our clients, but it might make sense for some of them. And so what is the reverse mortgage? Well, the reverse mortgage is very much like a traditional mortgage, and I've started explaining this different over time. A reverse mortgage is a federally backed by the full faith and credit of the United States government, mortgage that essentially says you can't owe more than this mortgage ever becomes. That you can't, if your debt becomes more than your house is worth, the government essentially pays that off. And so there is a stopgap associated with this that brings some level of security. This is a government-regulated product, and it's changed tremendously over the years. This is not the reverse mortgage that exists today that existed 10 years ago. Actually, from a functional standpoint, it looks almost nothing like it. It's changed tremendously, and a lot of consumer protections have been added. So how does it work? So the idea is at age 62, you can tap into your home equity through the HECM, which is Home Equity Conversion Mortgage Program, which is kind of the short for the reverse mortgage. And so under that program, you can tap into your home equity in a number of ways. Either what we say is a lump sum amount. You can't get it all out the first year. That's been one of the consumer protections that have been added. But a lump sum, you can get a 10-year option that essentially functions similar to a lifetime annuity for as long as you live in the home, or a line of credit option, which is become kind of the more go-to version for financial advisors, setting up the line of credit, not using it till you need it. Or you can actually use any mix of those three. So those are kind of our distribution options. From a general standpoint, closing costs and mortgage fees now are pretty close to traditional mortgage, so the same type of closing costs, process, title insurance, all of that pretty much exists with the reverse mortgage. Fees and costs have come down substantially there over time. Now the government keeps making modifications to the program. Actually, October 2nd this year, 2017, they made some substantial changes to the program, which actually benefits any consumer that utilizes the program and borrows over time. So there's been some negative press on that, but actually from my analysis and one of my colleagues, Dr. Wade Fowl, both of us see it as kind of a positive change for kind of taxpayers, that it's going to lower the burden of any type of risk here on the program and then also benefit borrowers. So it seems like it's pretty good change. Now, if you decide that you want to borrow from a reverse mortgage, right, you're going to have closing costs and kind of with the traditional mortgage. But the idea is really that you borrow money. The bank either is going to make ongoing payments, line of credit, or lump sum. You take money out, and it grows with interest. The debt does. Now, when do you have to pay that back? Well, you have to pay it back when you stop using the home as your principal residence, meaning that you die, you move to a nursing home, you sell the home. That's when it's owed. And again, you can't owe more than your debt. And so if your house is $400,000, debt's $200,000, you sell the home, you get $200,000, you pay off the $200,000 reverse. But let's say the opposite was true. The house has dropped in value. It's only worth $200,000, and the debt's grown to $400,000. Well, essentially, if you die or move out, you just hand them the keys. You're done. You don't owe anything more. It's a non-recourse loan. So these are being used reverse mortgage are being used now strategically in a couple different ways. One of them, as I mentioned before, is really just kind of setting up the reverse mortgage line of credit to function as a non-market correlated asset. And so when you set up a reverse mortgage line of credit, the line of credit is actually based off the house value when you set up the line of credit, and then it's no longer related. So if the house drops in value, your line of credit doesn't drop. It actually continues to go up. So it kind of separates it from the market a little bit and from kind of the general economy, which is very different than a traditional home equity line of credit that's tied to the constant house value. And so one thing is to set that up. And then when the market drops, you pull from a reverse mortgage instead of the market. When the market recovers, you pay back the reverse mortgage. And that's research that's been published in the Journal of Financial Planning. Professor Barry Sachs and Professor John Salter actually had two different publications that came out the same year, slightly different testing mechanisms, but came up with the idea that that works very well as a retirement income strategy. So any advisor using some type of systematic withdrawal strategy would be well suited to look into that. Another popular strategy, and I think this is kind of the future of using home equity, is, as we mentioned earlier, more and more people are moving to retirement with a existing mortgage. And so that's a cash flow becomes king in retirement. We need cash. We need money. We need to be able to spend. And if all of our Social Security income is going to pay the mortgage, we can't live very well. And so if people want to age in place, they don't want to downsize, they don't want to sell the home, they want to keep living there, one strategy is actually to basically flip our traditional mortgage into a reverse mortgage. And you can either decide not to make payments, or you can just make payments. You could just come up with your own 20-year or 15-year amortization schedule, make payments every month. But what the reverse mortgage does is provides you flexibility that if you decide one month you don't want to make payments, you don't have to. Or if you decide for a whole year you don't want to make payments, you don't have to. And there's no foreclosure. The debt just grows. You use up your home equity to do that. And honestly, I think a lot of people would feel comfortable with that even with a traditional mortgage. Sometimes I ask a room, would you be willing to pay slightly more for a traditional mortgage, that if you lost your job for a year you didn't have to make payments and you could just stay in the house? And a lot of people say, you know what, I would do that. And that's kind of what a reverse mortgage provides us in retirement, that you can set it up, you're getting your income from the markets, but the market bottoms out. Well, that's kind of like losing our job. And I don't want to, have a mortgage and have to be worried about making those payments in retirement. So all of a sudden, I can just stop making my reverse mortgage payments and let the debt grow for a year. And then if the market recovers, I can go back to making payments. So it doesn't have to be this all or nothing where we give up all the home equity, we pull it all out. That's probably not a great strategy, but kind of using it strategically is. And so I think that's, probably a good, just a different way to think about it for people, kind of opening up your mind, taking a look at it, looking how it can be used. And there is a growing body of research around this, and it's still fairly new, about 2012. I mentioned Barry Sachs, John Salter from Texas Tech, and Wade Fowler, really kind of the primary researchers in this area.
What are the tax consequences regarding whether it's the lump sum or the annuity payments?
Yeah, so a great point about that is, generally speaking, any reverse mortgage payment is non-taxable because it's actually borrowing. So if you draw from a line of credit, you get a 10-year payment for the rest of your life, or you take a lump sum draw. All of that is tax-free income, which actually allows very sophisticated strategies, things like doing Roth conversions, Medicare premiums, making sure that you kind of don't bump into a new a new tax, the fee brackets there for your premiums. And sometimes, you might need $1,000, and $1,000 extra of income, taxable income, could cost you $3,000 in Medicare premiums with Part D and Part B and your supplements. So all of a sudden, using a reverse mortgage in those situations just to supplement a little bit of income here and there through retirement because it's non-taxable is very useful. Now, there is one caveat to all of that is If for some reason your house, as I mentioned earlier, you can basically have $500,000 of kind of growth in the house before you ever need to pay taxes. If for some reason you could, it's almost unfeasible, it's really not feasible under the current reverse mortgage program. But if for some reason you had a $500,000 extra of reverse mortgage payments, you live to 125, it's possible at the end of your life when the debt's forgiven, you could have some taxable income. But the odds of that, honestly, if that happens, that's great. But yeah, you would never have that taxable income until the debt's actually paid off, and you'd have $250,000 or $500,000 over your basis in the house, which again is for a program that caps out at around, I'll just say, is kind of $650,000-ish that you can borrow from, kind of include your house in. Having an additional $500,000 over that is really not really feasible. It's never happened in the program, so I'm explaining something that's never happened, and I have trouble imagining happening. But under the law, it technically could. So then people at least mention it, but it's never happened in the existence of the program. So,
okay, let's go back to the annuity option there. I just want to clarify something. I thought I heard you say it's a 10-year perpetual payment.
Well, 10 years. So, yeah, it pays you for as long as you live in the home. So if you set it up at 62, you live in the home till you're 95, you die, it makes payments the entire time. Now, if you live in the home from 62 to 75 and you decide you want to move somewhere else or you want to sell the home, whatever your existing outstanding debt is at that point based on the payments and the interest, you would owe that. So if you sell the home, you'd have to take that out of your sales price. So yeah, it's a 10-year payment, so not 10 years. They sound very similar, but 10 years. So it pays you for as long as you live in the home.
That makes more sense. Okay, so how is the bank underwriting that? So if a 62-year-old is really healthy and they're going to live into their 90s, how do they, from an actuarial perspective, figure out how much they're going to pay them? There seems to be a lot of risk.
Yeah, so this is actually a really interesting area. So the program, because it's a federally directed program, there's really not a whole lot of what we would say kind of a true underwriting. Somebody with longevity in their family or somebody without, they really get the same payment. The payment is based off your house value. That's really what's kind of the underlying asset. So it's based off of that. They don't look at your actual health to do the payment. So somebody who does expect to live a long time, it could be a better option for them. But again, your house is still kind of securing that debt. And that's really how it's based off of, is that, they don't expect the payments to use up all your home equity. But if it does, that's why there's a Federal Housing Authority mortgage fund that actually backs any house that, any payment that would kind of put the house underwater. And so, yeah, they don't do a whole lot of underwriting in that sense. They don't really do underwriting via areas either. So areas with kind of houses that might be depreciating in value, again, could be a good place to get a reverse mortgage if you plan on staying there and you don't think the house is going to go up in value. Also makes sense because you're kind of protecting against the downside of the housing market. That's not a really, I think that's a tough strategy and really not the public policy behind the program, but in reality, there's still some functioning of that.
Sure, it could mitigate it could really mitigate some longevity risk.
Yeah, absolutely. And, it's so what we've seen, some of the researchers, Professor Mark Warshawski did a research project for MIT last summer, 2016, and he kind of compared the reverse mortgage 10-year payment and the payout rates to commercially available annuities. And they're fairly comparable. So what he saw is they actually do a fairly good job at kind of keeping up with the market. And it seems to be a better deal the earlier you use the 10-year payment. So setting it up at 62, 63, 64, 65, comparable to a market annuity is more comparable than if you wait longer. And that's been pretty true throughout all the reverse mortgage strategies we've seen. Is they tend to be better off the earlier you incorporate home equity as opposed to waiting. So there was a time period when FINRA, and this is a lot of people still remember this, FINRA actually had an investor alert about reverse mortgages. And in it, it always said that reverse mortgages should only be used as a last resort. Well, since 2012, and this research has been coming out, all the research is actually pointing to the opposite, that reverse mortgages and home equity should be used early in retirement, not late. And that FINRA has since removed that language due to this research, that it's actually changed FINRA's position. And they actually have a much more open position on reverse mortgages than they used to based on this research. And conceptually, it kind of makes sense. We kind of know that the default position of absolutely doing nothing till the end is almost never a good strategy. Whenever you see something that says, well, just don't do anything with it. Well, I can't tell you very many good strategies where that's the strategy, right?
Yep.
You have to be proactive everywhere, and that's true here too. Now, that doesn't mean a reverse mortgage is good for every client, but, it definitely fits a certain group. And we also have to get buy-in from clients here. I mean, some people just don't want to spend down their home equity, and that's okay, right? Like, we also have to realize there's people and there's emotional attachment to the home and the American dream. I even saw a story this week about that said, it was a nonpartisan issue either. Both Republicans and Democrats said owning a home is key to having the American dream. And I think both groups were in the 70s that agreed with that statement. And so that's still part of the country, right? Like we view home ownership as important, and you pay off the home. And for a lot of people, that might be the only financial decision they've ever really felt proud of, that they bought and paid off their home. So, we have to be cognizant that they might not want to borrow from the home again in retirement, even if it is beneficial to them from a, math and science and financial standpoint. We've got to balance that with what clients actually want.
Sure. All right, so this question might be a little too granular, but just looking at the line of credit option, I don't see where you hurt yourself at all just setting one up, just in case. What am I missing?
So actually, you're kind of on board with a lot of people now. I'm in that camp. And one of my other professors, he hit 62 this year, and he set one up. And so the downside there is not a whole lot. Now, there is up until October 2nd, 2017, there were actually no cost line of credits. There were companies out there offering the federal HECM reverse mortgage and basically just being willing to pay all the upfront fees and costs and say, hey, look, we're just going to eat that because we want you to, set up, and we know that, if you borrow later in the future, we'll kind of make up some of that. From that standpoint, it actually makes perfect sense. You set it up, it's there, you don't have to borrow from it if you don't need it. Now, what I do say is if you're an advisor that starts to go more on that route, the one thing we do have to be wary of is people that we don't trust with their spending, right? If we set up a reverse mortgage line of credit, we all know somebody who, if we set that up for them, they'd pull all the money out pretty quickly and spend it all, right? They'd buy a boat and go on vacation. Well, if they're not, kind of safe and kind of responsible with their money, there's a good reason not to set one up kind of immediately. Maybe we do wait. But generally, it's a good strategy to set it up as early as possible. The line of credit tends to be more beneficial the earlier you set it up rather than if you wait. It actually outpaces. There's some growth factors if you set it up earlier or wait to set it up. If you set it up early, it tends to give you more access to more money than if you wait. So there's a bit there. But now today, kind of putting one caveat on this, is that after October 2nd, we're going to have to wait and see how the market shakes out. The government kind of changed some of the ways that the fees are charged, and they actually moved some things to a higher upfront fee to the insurance fund. So your mortgage insurance premium is more now of kind of a one-time payment, and they dropped the ongoing interest rate by actually 0.75%. So for any active borrower, the program is a lot more kind of palatable. But for somebody who's going to just set up a line of credit that didn't want to pay anything for it and just leave it there, that strategy, we'll have to wait a couple months to see what companies decide to do. They might start requiring some upfront payments now, at least to the mortgage insurance fund up front. So it could have a couple $1,000 cost to set it up at this point. But again, I'm still in favor of that. I think it's a great strategy. If you have anyone that's kind of doing systematic withdrawals from a portfolio, that makes a lot of sense.
That's a great segue into advisor compensation for utilizing these products. What does that look like?
Yeah, so financial advisor compensation should be a no. I have a very strong opinion on that. There's financial advisors should not get paid off of the reverse mortgage transaction.
Are they?
Meaning,
are they compensated on it?
The financial advisors are not. No.
Oh, perfect.
And they shouldn't be. Yeah, so that's pretty straightforward. Now, the lender, the originating officer on the reverse side is paid. And I actually say if you're a financial advisor and you're going to work with somebody that's originating these, I would ask about how they're compensated. So there's a couple different models out there. There's the model that I kind of steer people away from. It's not always bad. If you find somebody you really like and you feel comfortable working with them, fine. But there is a model where the loan officers actually get paid by the percentage draw that the homeowner takes out. So they're actually incentivized to convince the homeowner to withdraw as much money as possible out of the reverse mortgage. I, as an advisor, wouldn't want to work with somebody who has that incentive to draw as much as possible out.
Sure. Yep.
Right? I want to work with somebody who's paid either they're ones that are paid as a flat amount or just as a percentage of the home. I don't have a problem with that. That just means that at least the advisors or the originators are incentive to find people with larger valued homes. That doesn't scare me. And unfortunately, that's most of financial services too. Is we're looking for higher net worth clients, not people with lower money. So, but what we don't want is to be convincing somebody to borrow more than they need to borrow. So I think it's a worthwhile question to ask, as the originator, how are you compensated? Is it a flat fee per? Is it based on the home value, or is it based on the draw amount that the person takes out? And again, it doesn't necessarily make them a bad originator, but you at least should know about it. So when you're getting advice from them, you know that they have a conflict in that area.
Jamie, I have learned so much on this podcast. In fact, when I started this show at the beginning of the year, if somebody had told me I would do a 30-minute podcast on the viability of reverse mortgages, I would have said that podcast is going nowhere. So I've learned a lot. Is there anything we need to know before we wrap up that we didn't talk about? Anything advisors need to know?
Well, I'm going to plug. I have no relationship to this at all, but I'll give you a couple resources here. So there is one of my colleagues, Professor Wade Pfau, who a lot of the people listening will be aware of. He's fairly well regarded in the research community. He actually has a book on reverse mortgages. It's actually the only book on reverse mortgage not written by somebody in the reverse mortgage industry. You can buy it on Amazon and things. So I don't know how much it costs. Honest, he gave me a couple books, so I never bought one. But it's a great book, and if you're somebody that listens to this and says, "Hey, you know what? I'm interested in this. I actually want to read it myself." That's the best resource in existence. So he's got a whole book on reverse mortgage and retirement income, Wade Pfau, and then that's PFAU. And then the other thing is there's 3 companies out there, and I don't know if that's something that you like to do, but I always say there's 3 companies. I would always shop around out there. Actually, LendingTree allows you to shop reverse mortgages now too. But Quicken Loans has a company out there called One Reverse. So they're a big company. People usually feel comfortable. They say, "Hey, Quicken, I use them." There's another one called RFS, Retirement Funding Solutions. And then Longbridge Financial. So I've dealt with a lot of the reverse companies. Those 3, I find it to be very reputable. They have good compensation models. They're run by legitimate organizations. So the Longbridge is actually run by the professor. Actually, he runs the real estate division of Columbia University. So he's very well respected. Has been in front of the Senate a million times during the housing crisis. And so those three companies, if you decide to look at this, they're a good starting point. But again, shop around. It is a government-regulated product, but prices do change from company to company.
I will put links to all three of those companies in the show notes. How can listeners find out more about you and your work?
So I am a professor at the American College. I am on Twitter at Retirement Risks. Most of the articles, research I publish go on there. I have my own website, hopkinsretirement.com or hopkinsretirementresearch.com. They both link to the same place, but hopkinsretirement.com.
Excellent. Jamie, thank you so much for coming on.
And thank you again, Jay, for having me on.